For over a decade, Wall Street treated Bitcoin as a speculative tech stock, a risk-on playground for retail traders. The noise you've heard for years is that crypto is too volatile to ever underpin core brick-and-mortar infrastructure. But earlier this month, the barrier between decentralized wealth and institutional finance didn't just crack, it vanished. Better Home and Finance, partnering with Coinbase, officially funded the first-ever United States mortgage using Bitcoin as collateral. This wasn't a boutique, high-interest private loan from a crypto startup. This was a Fannie Mae-backed conforming mortgage. The companies have confirmed nationwide rollout for qualified buyers by the end of this summer. This is a massive structural milestone. For the first time, a buyer used their digital assets to buy a house without selling a single Satoshi, entirely avoiding capital gains taxes while keeping their long-term upside intact. Today, we analyze the structural ripple effects. What does this do to the liquid supply of Bitcoin? How does it rewrite the rules of the U.S. housing market? And what happens to the broader economy when digital scarcity becomes the bedrock of American real estate? My name is Newell. Welcome back to the Signal and Noise podcast. Let's dive in. Let's start with the immediate math of the asset itself, the supply dynamics. Historically, investors had to sell their Bitcoin to fund major life milestones, weddings, businesses, or down payments on real estate. Selling creates velocity and puts coins back into the open market. This new collateral mechanism creates a liquidity black hole. When buyers can pledge their Bitcoin to secure a 30-year fixed traditional mortgage, that Bitcoin enters deep institutional escrow. It is completely taken out of circulating supply for decades. Bitcoin's liquid supply on exchanges is already sitting at historic lows. If even 2% of the trillions of dollars locked in global housing transitions over to Bitcoin-backed collateralized debt over the next decade, we are looking at a supply squeeze the market has never priced in. When demand increases exponentially for an asset with a fixed supply cap of 21 million, and a growing percentage of those coins are locked in housing escrows, the price response isn't linear, it's explosive. This brings us directly to crypto pricing models. If adoption continues down this trajectory, we are leaving behind the old 4-year halving boom and bust cycles. In macroeconomics, pristine collateral is an asset that lenders accept with minimal friction because it is highly liquid and globally verifiable. Traditionally, U.S. Treasuries and gold filled this role. Bitcoin is proving to be superior collateral because it can be audited instantly on-chain, 24/7, without relying on physical audits or clearinghouses. Because individuals do not have to liquidate, they do not trigger capital gains. This allows early adopters to pile their unrealized wealth directly into real estate equity. Of course, the bears point to the obvious friction point: volatility. If Bitcoin experiences a standard 60% cyclical drawdown, these products require robust risk mitigation. Lenders like Milo and specialized firms are engineering over-collateralized models or automated buffer cushions to prevent flash liquidations. But because these are conforming loans backed by Fannie Mae, the federal backing introduces a layer of institutional stability. Now let's flip the script and look at what this does to the real estate market. The U.S. housing system is profoundly broken for the younger generation. The median age of a first-time American homebuyer has climbed over 40 years old. Traditional mortgages were built for a 20th century economy: W-2 tax documents, predictable fiat savings accounts, and single-employer careers. But millions of younger, qualified buyers have built their primary net worth inside digital asset networks. The mortgage system previously looked at a buyer with $500,000 in Bitcoin and treated them as a high-risk ghost. With companies like Milo and Better launching crypto-backed mortgages, buyers are walking into real estate deals with up to 100% financing and zero cash down, purely using their digital portfolios as the guarantee layer. This will drastically increase the purchasing power of the digital native class. It creates an entirely new demographic of homebuyers who can outbid traditional buyers relying on fiat savings. We can anticipate real estate premiums inflating heavily in tech hubs. Finally, let's zoom out to the broader U.S. economy. This is the ultimate signal of institutional co-optation. While global central banks talk about moving away from the U.S. dollar, the U.S. housing market remains the largest, most stable asset class on Earth. By allowing Bitcoin to act as the pristine collateral layer for Fannie Mae conforming loans, the U.S. financial system is essentially anchoring global Bitcoin wealth directly to American soil. The next logical macro step is the securitization market, the birth of Bitcoin mortgage-backed securities, BMBS. Wall Street will soon bundle these crypto-collateralized home loans into yielding financial products for pension funds and sovereign wealth entities. This hardens the stability of the U.S. financial system by backing its debt instruments with an asset that cannot be hyperinflated by a central bank. So, what's the verdict? The noise. Bitcoin is a volatile internet token with no place in housing finance. The signal. The federal mortgage apparatus has officially accepted Bitcoin as pristine, conforming collateral. The financial paradigm has shifted from liquidating crypto to borrowing against it for hard assets. If you are a long-term holder, the mandate is clear. Your digital assets are transforming into an institutional line of credit. Do not build your wealth strategies around the assumption that you will eventually have to cash out to fiat to live a real-world life. The legacy banking system is building the pipes to let you stay in Bitcoin forever. The virtualization of property has met the physical world. Stay sharp, stay focused. That's it for this edition of The Signal and Noise. My name is Newell. Please, this is not financial advice. Do your own research. If you want to own the future, you have to understand the collateral that builds it. Do like and subscribe. We'll see you in the next one.